Okay, let's talk about Chapter 11. Chapter 11 deals with corporate organization, stock, transactions, dividends. We'll talk about accounting for corporations more specifically and some things that affects corporations in particular. So some of the topics will be the nature of the corporate organization, two main sources of equity for corporations, the different classes of stock, the entries to issue stock. We'll talk about accounting for dividends, both cash and stock dividends. We'll talk about treasury stock transactions, and also stock splits, reporting of equity, and then earnings per share. So lots of topics to cover. So the first topic is the corporate form, just kind of what that is about in terms of how corporations are set up and just some things to think about. So it's a separate legal entity. It's distinct from individuals who create it and operate it. As a legal entity, a corporation may acquire, own, dispose of property in its own name. So a corporation can own something. It sells shares of ownership called a stock. And of course, these are set up by laws that create corporations and allow them to operate. So stockholders, anybody who owns stock in the corporation, you can buy and sell the stock without affecting the corporation's operations or existence. You and I can go out and buy a share of stock of, or shares of stock of any company we want, and the company just keeps on going. So a public corporation is any share of stock that you and I can go out and purchase. Corporations whose shares are not traded are usually owned by a small group of investors called non-public or private corporations. The stockholders of these corporations may have some limited liability. If you own stock of a publicly traded company, you really have no liability. The only liability you have is your share of stock, and basically if that were to go, value go down to nothing, that's pretty much it. You only can lose what the value of your stock is. Corporations have to have a board of directors. The board meets periodically and they establish corporate policy. They select top officers of the company, and then the top officers report to the board. And so you can see here the organizational structure of a corporation. The stockholders own it. They elect the board of directors. The board of directors selects the officers who run the company, and of course the officers then hire employees to work for the company. So a separate legal existence from its owners. Transferable units of ownership. You can go out on a stock exchange and buy and sell these all the time. Limited stockholder liability, and it is subject to taxes. Therefore, one major disadvantage for the corporate form is what they call double taxation. And basically the corporation itself pays tax, and then as dividends are distributed to the owners, those dividends are also taxable. So basically a corporation pays tax on its income, and then as income is distributed to owners through dividends, dividends are also taxable. So that's kind of small to read, but just the characteristics, Exhibit 2 from your book, just some key things to remember and take away, advantages, disadvantages wise. And keep in mind that these are really easy things for me to ask you on the test or a quiz, so you want to make sure you know these, what they are. That would definitely benefit you. So let's talk just a little bit more here about what those are. So separate legal existence, it's completely separate from its owners. Has a continuous life. One downside of a proprietorship or a partnership is that if the owner were to die, basically the company does not exist anymore. Of the corporation, a shareholder can die and it does not affect the running of the company at all. Raising large amounts of capital, it's easy to raise a lot of capital when you sell stock. Obviously, that's a main advantage. Ownership rights are very easily transferable. They're traded every day publicly. It just takes a matter of moments to buy and sell a share of stock. Limited liability, basically for the owners, they have no liability. If the company were to go bankrupt, if they own a stock in, basically the only loss is the value of the stock. A bank cannot go after stockholders for funds that were not repaid, for example. So basically a bank would lend money to the corporation, and if the corporation can't pay it back, that's where it ends. Some other items to think about here are some disadvantages. The owner is separate from management. The stockholders control management through the board. The board should represent shareholder interests. However, it says quite often the board is more closely tied to management and management's interests rather than the shareholders' interests. So they don't always work on this with the same agenda. Let's put it that way. And the double taxation of dividends that I mentioned, and the regulatory costs. It's very expensive to have the corporate form because of the legal and reporting requirements. You have to be audited. You have to adhere to Sarbanes-Oxley laws. It's a very expensive form. It might cost you a couple $1,000,000 a year in terms of the extra accounting, audits, and legal costs and reporting costs that you have just to be a corporation. So it's not a cheap thing to start. So you want to make sure your corporation can obviously support those expenses. So becoming incorporated, the first step is to basically apply to become incorporated with whatever state you want to be incorporated in. State laws differ. Corporations are organized in states with more favorable laws, and Delaware being one of those states where the laws are very favorable, and many corporations are incorporated in Delaware. And the next slide will show this here. Basically some really big companies and where they're incorporated at, which could be completely separate from where their company headquarters is. They don't have to be in the same place. So once the application is approved, the state grants a charter or articles of incorporation, which formally creates the company, the corporation, and every state has what they call a Secretary of State, and that is the department that would handle these kinds of things. Management and the board then prepare bylaws, which are operating rules and procedures for conducting the corporation's affairs. So a bylaw is basically what management and the board put together that says here's how this company will be governed and run. So it says costs incurred in organizing corporation, legal fees, taxes, licenses, promotional costs, all those things are just a part of just expensed as incurred. And the entry to record those just simply called organizational expenses, debit, credit, cash, and just the cost of starting the corporation. The next topic is the sources of equity. And equity is called stockholders' equity, shareholder investment, or capital. Typically we say stockholders' equity. It's made up of two sources, basically paid-in capital and then retained earnings. Capital contributed to the corporation by stockholders, basically when stockholders buy shares. That's called paid-in capital. And then as the company itself is profitable and makes money, and net income happens, that's called retained earnings. So basically paid-in capital from people buying stock, and then retained earnings by the corporation itself being profitable. And so you can just see here is just an example of a slice out of a stockholders' equity section from a balance sheet. And excuse my cough. Let me get the whole thing on the screen here. There's one class of stock, we call that common stock. Okay, you have to have common stock. So every corporation, no matter what, has to have common stock. But there's a few classes of stock, and we'll talk about that later. So retained earnings then is just it's cumulative net income that's not been distributed as dividends. So remember, once you have net income, if you want to, you can pay some of that out to your shareholders, and that would make retained earnings go down, but retained earnings goes up for net income. And dividends is basically just distributing earnings back to the shareholders of the corporation. A debit balance to retained earnings is called a deficit. So it'd have a normal credit balance because it's an equity account. If it has a debit balance, it has a deficit, and that would just mean it's had a lot of net losses. It's had more losses than gains, and so you have a debit balance. Don't confuse a credit balance and retained earnings with cash either. They're not the same thing as cash. Let's talk about the different classes of stock in issuing stock. It says a number of shares of stock that a corporation is authorized to issue is stated in the charter. How many shares are they allowed to sell? Issued means the shares have been basically sold to shareholders. And then a corporation may reacquire some stock that has been issued. The stock remaining in the hands of stockholders is called outstanding stock. And so you have authorized, issued, and outstanding. Authorized, issued, outstanding. You may issue stock certificates to stockholders to document their ownership. Not everybody actually does anymore. Quite often it's done electronically. Shares of stock are often assigned a dollar amount called a par value, and some corporations have stopped issuing stock certificates except on special request because everything's done electronically nowadays. Stock issued without a par is called no par stock. Some states require the board of directors to assign a stated value to no par stock. It just depends on what state you incorporate in. Some state laws require corporations to maintain a minimum stockholder contribution called legal capital. The major rights that accompany ownership of a share of stock include the right to vote in matters concerning the corporation, and usually it's a matter of voting for who's on the board of directors and who does the audit. The right to share in distributions of earnings, and the right to share in assets upon liquidation if the company decides to liquidate. So classes of stock, I mentioned earlier that every corporation must have common shareholders, and then some also have what they call preferred stock. And if you have preferred stock, it's preferred in terms of dividends. They have a preference for dividends. They're ahead of line in front of common shareholders. So they kind of show down here a booth, money available for dividends, and the preferred shareholders are first in line. The commons have to wait if there's any money left over before they get their dividends. Okay, so you're preferred in terms of dividends. The payment of dividends, before a corporation can pay dividends, the board of directors must authorize that. When they authorize the payment, the company is said to have declared a dividend. Classes of stock, again, just to kind of keep going through that. Cumulative preferred stock has a right to receive regular dividends that were not declared or paid in previous years. Okay, so if a year goes by where dividends were not paid because the company maybe just had a bad year, had a net loss, or just short on cash, and they want to preserve their cash for operations, they can choose not to pay a dividend. But for anybody who owns cumulative preferred stock, basically what they're going to get their dividends eventually. So before commons can ever get dividends, the cumulative preferred shareholders must be caught up to date and made current. You can also own what they call non-cumulative preferred stock, and that does not have that right. So if a company doesn't pay dividends in a year, basically you're just out. Cumulative preferred stock dividends that have not been paid in prior years are said to be in arrears. So dividends in arrears are dividends that are that were earned by shareholders but not paid. They have to be paid at some point in the future before common shareholders can get dividends. So just continuing along with that, a corporation has issued the following preferred and common stock. You can see they've got 1,000 shares of $4 cumulative preferred stock at $50 par, and typically the par values for preferred stocks are fairly high, and then 4,000 shares of common stock at $15 par. And typically common par, if they have a par, is typically much lower. The corporation was organized in January 1, 2012 and paid no dividends in 12 or 13. In 14, the corporation paid $22,000 in dividends, of which $12,000 was paid to preferreds and $10,000 was paid to commons. Okay, so when they say $4 cumulative preferred stock, what they're saying is that share of stock should receive a dividend of $4 for the year. So obviously 4 times 1,000 is $4,000. So just think for 3 years, that's 4 plus 4 plus 4, $12,000. So that's where they came out with the $12,000. So anything that's left over above and beyond that is paid to commons, because the preferred shareholders, that's all that they can earn is $4 per share. They cannot earn more than that. And so because it was cumulative, so when they declared that $22,000 amount in 14, basically the preferred shareholders had earned 4,000 plus 4,000 plus 4,000 for the 12,000. And to pay a dividend then, it says total dividends paid 22,000. What was paid, I'm kind of got ahead of myself a little bit here, was 4,000 for 2012. And then of course 4,000 per year for each of the 3 years. Okay, so you can see right there, we get down to 2014, and 12,000 then is paid to the preferred shareholders. 2012s that were in arrears, 2013 in arrears, and the current dividend of 2014. So total paid 22,000 less the 12,000 paid to preferreds, of course leaves 10,000 available to pay to commons. And you'll have some problems like that when you do the problems in Cengage now. When a company issues stock, it says here a corporation is authorized to issue 10,000 shares of preferred stock at $100 par and 100,000 shares of common stock at $20 par. 1/2 of each class authorized is issued at par for cash. So we're authorized to issue several thousand shares. We don't have to issue them all at once. We can wait. We can issue just some of them now and some more later on. And so you can see here they're going to issue 5,000 shares of preferred, and you can see it's basically $500,000. 5,000 shares times 100 is my 500,000, and then 50,000 shares of common stock at $20 is my $1 million. So just keep in mind the entry to issue stock at par. This is at par for cash. So I debit cash, credit preferred stock, and credit common stock. So that's an entry that will definitely come up when you do the homework. Now it says that the stock is issued for a price above par. We call that a premium. If stock is issued below par, we call that a discount. And of course that will affect the journal entry that we come up with. And so here we have a premium on stock. We're issuing 2,000 shares of $50 par preferred stock for $55. So we're debiting cash for 2,000 times 55, which is my 110,000. I credit preferred stock for the par, 50 times 2,000. Anything above par is paid in capital in excess of par preferred stock. Okay, that's basically the entry I use to balance this out. So paid in capital in excess of par only is credited when I receive more cash than par. It says here a corporation acquired land for which the fair market value cannot be determined. In exchange for the land, the corporation issued 10,000 shares of $10 par common stock, and the current market value was 12,000. And so the point of this entry is just to say you can issue stock in exchange for another asset. You don't have to receive cash. If you need to buy land and you're cash poor, and whoever owns the land is willing to accept stock in return, that's a fine entry. You can sure go about and do it that way too. And they made a point to say that the value of the land cannot be determined. And normally when you do this for an asset, if you can value the asset, you debit the asset at its market value. In this example, we were told we don't know what that is, but we do know what the market value of the stock is, and we're exchanging 10,000 shares of stock. So we're going to use that as the basis. So 10,000 shares times $12 is 120,000. I also then credit common stock for 100,000, and I've got a current market value then of $12. And the extra $2, the $2 above 10, is 2 times 10,000 is 20,000. So I debit land for 120, credit common stock for 100, credit paid in capital for 20. You can also have no par stock. There's no par values associated with it at all, and that's a little bit easier in that the entry is a little bit cleaner. No big deal though. It says we're going to issue 10,000 shares of no par common stock for $40, and then we're going to issue another additional 1,000 shares for $36 a few weeks later. So very simple entry: debit cash, credit common stock for the price times the shares for both entries. Okay, there's no paid in capital to worry about. So some states require the entire proceeds from the issue of no par stock to be recorded as legal capital, And so in other states, no par stock may be assigned a stated value. So it's just kind of a legal semantics, really. The debit's the same, but what you credit could be a little bit different. So let's just say, take the data from the previous example, and let's just say that stock had a stated value of $25. You still debit cash for the same amount for both entries. You credit common stock for the number of shares times the $25 stated value, and anything above and beyond that is paid in capital in excess of stated value. Notice it's not paid in capital in excess of par, it's paid in capital in excess of stated value. So let's talk about dividends then. So lots of entries in this chapter, by the way, entries to issue stock, and dividends to, or entries to issue dividends also. So just be mindful of those entries and make sure you've got a good understanding of them. So cash dividends, a cash distribution of earnings by a corporation to its stockholders, is just simply called a cash dividend. 3 conditions must generally apply in order for a dividend to be paid. You must have sufficient retained earnings, it has to have a credit balance, you have to have enough cash on hand, and of course a formal action by the board of directors. Without that formal action, no dividend can be paid. The date of declaration is the date of the board of directors formally authorizing the payment. On this date, the corporation incurs a liability to pay the amount of the dividend. Okay, so basically, the date of declaration requires a journal entry to be made. And we'll look at that, what that entry is here in a bit. The date of record is the date in which whoever owns the stock will receive it, which is typically sometime in the future after the dividend is declared. Then we'll basically say whoever owns the dividend on this day, whatever that day is in the future, will receive the dividend. Date of payment is the date the corporation will pay the dividends to stockholders who own the stock on the date of record. So you have declaration date, then you have the date of record, then you have the day of payment. So know what those days are also. So an example to follow up with here. On October 1, Hibbert Corporation declares the cash dividends shown below. The date of record is November 10th, and date of payment of December 2nd. So basically they're saying if you own a preferred share, you receive $2.50. If you own a common share, you receive 30 cents. Okay, so that entry has to happen on October 1 to declare the dividend. On November 10th, we'll make an entry to pay the dividend, or whoever owns the stock on November 10th receives payment. No entry there, but on December 2nd, then we will record the payment on December 2nd. So October 1, the declaration date, Hibbert Corp records the following entry: debit cash dividends, credit dividends payable for the total amount of dividends to be paid. On November 10th, no entry is required. Basically, that's just the date we use to say who receives a dividend on this date. Whoever owns shares on this date receives the dividend. And then we have on December 2nd, the date of payment. We debit the liability, make credit cash. We actually transfer the funds to the accounts of the stockholders. So dividends can also be paid in the form of more stock. A distribution of dividends to stockholders in the form of the firm's own shares is called a stock dividend. Stock dividends normally are declared only on common stock and issued to common shareholders. On December 15th, the board of directors of Hendricks Corporation declares a 5% stock dividend of 100,000 shares, which is 2 million shares times 5%. Okay, so 2 million shares are outstanding, and we're going to pay a 5% stock dividend to be issued on January 10th. The stockholders on record of December 31st. Market price on the declaration date is $31 per share. So basically, just think of it from this perspective. Sometimes you want to reward your shareholders, but you don't have a lot of cash to pay dividends in cash, but you do have the ability to issue more stock. So occasionally a corporation will issue a stock dividend as a way to reward shareholders. So to record the declaration of the 5% dividend, we do this. Okay. So you can see here we debit stock dividends for 3.1 million, 3,100,000. We credit stock dividend distributable. It's that kind of that payable. We owe this amount for 2 million, basically the 100,000 shares times the par value. And then anything above and beyond that, and the par value was 20, so it's 100,000 shares times 20 is my 2 million. But remember that the shares had a market price of 31, and so that extra $11 times 100,000 is the 1.1 million. Okay, so we have to keep in mind par value and what the market value was on the date of the declaration. Okay, both those things affect my journal entry. So in total, 100,000 shares worth $31 each will be distributed to my existing shareholders. So if somebody owns 100 shares, they get 5 additional shares. Think of it that way. So at the end of the period, the stock dividends distributable and paid in capital in excess of par common are reported in the paid in capital section of the balance sheet. And so basically what we did is, it says the effect of the preceding stock dividends to transfer $3 million of retained earnings to paid in capital. It's just a matter of moving equity from one section to the other. Retained earnings would go down, but paid in capital would go up. Total equity still stays the same. So the stock dividend is distributed to stockholders by issuing 100,000 shares of common stock with this entry, and it's based on the par value. Okay, so before and after, this is stock dividends, before and after stock dividends. Total shares issued 10,000. After 6%, 10,600 are outstanding. And then it says here, number of shares owned by one shareholder. Basically, if you own 1,000, you now get 1,060. And your proportion of ownership stays the same. So if you own 10% of the stock before the dividend, you own 10% of outstanding stock after the dividend. So next we'll talk about treasury stock. Treasury stock is a corporation buying its shares back off the market. Okay, and corporation purchases its own shares of stock for a number of reasons. To provide shares to resale to employees. I used to work for a publicly traded company, and you could buy shares of the company's stock at a discount, and you bought it at the lowest amount possible every quarter is when you bought it. So you bought it low at a discount, and for that to happen, the company had to have that share of stock available to sell to you. Some corporations use stock as a way to compensate employees with bonuses, also to support the market price of stock. Just kind of keep in mind that part of a stock price is supply and demand. If there are fewer shares of stock outstanding, that's a signal that if there's more demand, the price will go up. So it's a way to hopefully make stock price go up for a company. But they do buy their own stock for a number of reasons, and it's a very common thing to do. And so it says here, on February 13, a firm purchases 1,000 shares of treasury stock, which was common stock at $25 par, for $45 per share. And it says we're going to use the cost method of accounting for treasury stock, and the entry is as below. Debit treasury stock and credit to cash. And so that's just exactly for the market price, 1,000 shares at a price of $45 each. On April 29th, we're going to sell 600 shares of that treasury stock for $60. Entry to record the transaction is as follows. So we're going to debit cash for 60 times 600, which is 36,000. Credit treasury stock for the original cost, which was the, going back a screen, $45 per share. And so 45 times 600 shares. And then we generate basically a gain, is the only way to say it. $15 gain per stock. So we go from 45 purchase, we sell at 60. So that's $15 times 600 shares is $9,000. So basically we just generated paid in capital of $9,000 by buying low and selling high. Now notice that all these entries only affect the equity section. None of them affect the income statement. And so a company can use treasury stock as a way to buy low and sell high and generate more capital. Okay, that can happen. Of course, you could buy high and sell low and lose capital also. We're going to sell the remaining shares for $40 per share. So now we're going to sell them for $5 per share lower than what we originally paid. So now we're going to lose. So now we're going to debit paid-in capital from treasury stock, and that will now go down. So also keep in mind that treasury stock itself has a normal debit balance. It's kind of like a contra equity account. So most equity accounts have a credit balance. But treasury stock, and going back to the first entry about treasury stock here, has a debit of $45,000. You can see here, and so it reduces equity. So this entry will make equity go down. Assets goes down, and equity goes down. So we'll go down to the next section here, reporting on equity. Okay. In your book, Exhibit 4 shows 2 methods for reporting equity, and actually we'll have it on the next screen here too. December 31, 2014 for Telex Company. The first method, known as shown in this next slide, each class of stock is reported, followed by related paid-in capital amounts. Retained earnings is then reported, followed by deduction to treasury stock. Okay, so let's look at this one first. Okay, so notice in the equity section, then we've got paid-in capital. Preferreds are always first. Okay, then we show the par value. Then we show the excess, the paid-in capital associated with that. Then we show common stock plus the excess, the paid-in capital. And then also equity earned due to the sale of treasury stock. And then we have total paid-in capital. Then we add of 1.2 million, 1,202. Then we add retained earnings. And we get total equity minus treasury stock. Okay, that's deducted at the very end because all these accounts have a normal credit balance except for treasury stock, which has a debit balance. The second method, shown on the next slide, stock accounts are reported, followed by paid-in capital as a single item, additional paid-in capital. Retained earnings is then reported, following a deduction from treasury stock. So this one is preferred. You can just see that the par value, common at par, total paid-in capital for both classes in one line, total paid-in capital, retained earnings of $350, deduction for treasury stock, and then my grand total here of $1,525,000. Reporting retained earnings says changes to retained earnings may be reported using one of the following: separate retained earnings statement, combined income and retained earnings statement, or a statement of stockholders' equity. So you kind of have your choice when it comes to reporting and how you do this. So here's an example of a retained earnings statement. It says when a separate retained earnings statement is prepared, the beginning balance of retained earnings is reported. So basically on January 1 of the year, my retained earnings was $245. It goes up for net income and it goes down for dividends. Okay, so net income makes retained earnings go up, dividends make it go down. So I have new ending retained earnings of $350. You can have restrictions on retained earnings. It says retained earnings available for use as dividends may be restricted by action of a corporate's board of directors. These amounts are called restrictions or appropriations. They remain a part of retained earnings. They must be disclosed in the notes to the financial statements. So an appropriation can only happen through board of director action. Some examples would be legal. State laws may require a restriction. Contractual. There might be maybe some debt or something like that you have that requires that you have some restricted retained earnings. Or discretionary, you can just do that voluntarily to set funds aside for maybe some future growth or a future project. You can have what they call a prior period adjustment. Errors may not be discovered within the same period in which they occur. So you close the books from one year, then you open up the books for the next year, start doing your business, and you realize you made a mistake in the previous year, and you don't catch it until the next year. But when you catch it, you need to fix it. And so you do what they call a prior period adjustment, basically readjusting retained earnings to what the correct amount should have been had we found the error during the year that it happened. When the only change in equity is due to net income or net loss, retained earnings statement is sufficient. When a corporation also has changes in stock, such as paid in capital, statement of stockholders' equity is normally prepared. So if you're buying and selling stock, then you probably would go with the statement of equity method. And that is right here. So basically, you take your all of your classes of equity, your preferred stock, common stock, additional paid in capital, retained earnings, minus treasury stock. You go through what made each one change. You have beginning balances at first. Net income makes retained earnings go up. Dividends makes retained earnings go down. We issued some stock right here, some common, and we had some additional paid in capital because of that. And we bought some treasury stock, and now we have our new balances. Okay, this is actually very common to do it this way. I used to do financial reporting for corporations for 20 years, and I did one of these every quarter. Did one of these exactly like this. So our sample company in the book is called Morning Joe, and they're just going to show us some sample information from Morning Joe here. And we've got their equity section where they have the preferred stock first, the excess and par for preferreds, their commons, excess and par for commons, so total paid in capital, plus retained earnings, minus treasury stock, gives me total equity. And they can do a retained earnings statement also. Beginning retained earnings plus net income minus dividends equals my ending retained earnings. And then they can do it the third way right here. So you can just kind of see the same data just sliced and diced differently based on the three choices we have for reporting equity. Stock splits is kind of the next thing to talk about. A process by which a corporation reduces the par or stated value of stock and issues a proportionate number of additional shares. So Rojek Corporation has 10,000 shares of $100 par common stock with a current market price of $150. The board of directors declares a stock split. Each common shareholder receives 5 shares for each share held. The par value then goes down. So we take the par value of 100, divided that by 5, we would get 20. And so it does not affect total equity, just so you know. Oops, did not mean to go down there. Does not affect total equity. It's still $1 million before and after. It's just that the number of shares increase, but the par value goes down, and the total is the same. So before the split, you'd have 4 shares at 100. After the split, you'd have 20 shares at 20. Still $400 par value for both. A recent example of this is Apple did this. Apple Computers not that long ago. So basically, they did a 7-for-1 stock split. The reason they did that is their share price was really high. It was around $700 when they did it. And quite often, a corporation will do a split because then the stock price comes down, which makes it more affordable, and more people can afford to buy it. So Apple did that. They did a stock split. So if you owned 1 share at $700, after the split, you own 7 shares worth $100 each. So your total value didn't change, just that you had more shares worth less. But the total, it was the same. And then we'll talk about earnings per share a little bit here. Corporations are required to issue earnings per share information. EPS is what you'll see about earnings per share. It's a fairly simple formula, net income minus preferred dividends. So when we talk about earnings per common share is really what we mean. So we're really focused on the common shares and the earnings attributable to each share of common stock. And we have to back out preferred dividends from net income to get there. And we divide that by the average number of common shares. So it's a fairly straightforward formula. It's not too hard to compute. But just be aware of what that earnings per share formula is. You see it right there. And so here's the same formula at the top here. They're going to do this for Google. And they're showing net income for 2 years. They show the average number of common shares outstanding. And you get your earnings per share number. Okay, so basically they didn't have to worry about preferred dividends here. It was just taking the 6,520,000 divided by the average number of shares, get $20 over here. Okay, so that's a really high earnings per share number, by the way. But just know that formula, and just know that GAAP rules require that you report this information. And that is the end.